Hey, we do have a couple people still joining, but I will get going just so we maintain our schedule. So thanks to everyone so far because we have kept our schedule. So that's great. So again, welcome to the 2021 Lumsden and McCormick Virtual Exempt Organizations Conference. I'm Maria Gambacorta. I am the Director of Marketing here at Lumsden and McCormick. So I'm going to serve as the host and moderator for the session today. Before we get to introductions, I did want to go through a few housekeeping items. This session is being recorded and the recording will be shared. We'll send an email probably by the end of the week, and it'll be on our website. And you could also access the slide decks on our website as well. In today's reminder email, this session, both the Excel file that Sarah and Seth will go through and the slide deck is linked in that email, so you could access that as well. Q&A and chat are both enabled. So if you have any comments for me or general comments, or you can put them in the chat. Questions for Seth and Sarah, if you could please put them in the Q&A section, and we'll try to get to them throughout the session. If we can't, we will handle them at the end. We are offering 1 hour of CPE for this session. There are 4 polling questions, so you need to answer all 4. There's also a survey that will automatically launch at the end of this session. And if you would complete that survey as well for CPE credit, we will email you the certificates within 30 days. You'll get, if you attend all 6 sessions, you'll get 6 separate emails with the certificate for each individual session. So again, if you have any questions, give me a minute and I'll my name and email in the chat, and you could email me directly with any of those questions. So I'm going to move on to introductions now of Seth and Sarah. The presentation is GASB 87 Leases. Sarah, as many of you know, is an audit partner, and she works with governmental entities and nonprofit organizations. The governmental entities she works with are school districts, public authorities, and municipalities. Seth, I'm going to start out with congratulations to Seth. Many of you probably saw back in November, Seth was named partner, and that will be official on January 1st of 2022. So congratulations to Seth. Seth is also in the audit department, and he serves exempt organizations, including municipal and other governmental entities, along with school districts that include school districts, and he works with nonprofit organizations, including healthcare institutions. So I'm going to turn the program over to Sarah and Seth.
Thanks, Maria. So I think Sarah and I have done GASB 87 leases for a number of years. It's been on the horizon for a while. So we kind of struggled with what to present for this in 50 minutes because there's some entities that have started this process and are well into the process of figuring out what leases they have and evaluating those. And other entities have not yet begun this. So we want to give some overview of kind of what GASB 87 is, the effective date, purpose, scope of it, kind of go through those somewhat quickly, go over the defining the lease term, which is actually more confusing than it probably seems like it should be. We'll talk about the lessee and lessor accounting for those, and then Sarah's going to get into some special situations with incentives, modifications, terminations of the lease contracts, some implementation tips. You may have noticed in the links, there's an Excel sheet that we've kind of developed that's still kind of being tweaked here and there, but that helps with determining what is applicable for GASB 87. And we'll wrap up with going through some implementation guides and kind of some the GASB's FAQs on kind of some significant issues that they've seen and kind of the areas that they think most people are having questions on. So to start with, let's kind of go through this relatively quickly for those of you who have not really looked into GASB 87 yet. It's been pushed back because of COVID, so the effective date is now really with the June 30th of 2022 financial statements. So those are really the first entities that are going to be required to have a financial statement that is in accordance with GASB 87. Just keep in mind that it is retroactive to the earliest period presented. So if you have a single year financial statement, then you're going to be retroactively adjusting for GASB 87 for July 1st, 2021. And if you have a comparative financial statement for 2 years, that'd be July 1st, 2020. So depending on your financial statement presentation, you could have to go back even previous to now, to show comparative financial statements. Obviously, there's options to do a single year presentation, and you'd have to disclose in the notes why you did not want to show comparative if that was your choice. But basically, June 30th of this year is the first time you're going to see most entities doing GASB 87 and going forward. So the purpose and the scope of GASB 87, just kind of the main purpose of this is it really changes the old capital asset or capital lease versus operating lease. And now it's really just kind of the one foundational principle is the lessee going to be using another entity's asset? And that's really what it comes down to. If you're going to be using someone else's asset for a period of more than 1 year, it's probably subject to GASB 87. And how that's going to look is it's basically be a capital lease. There's not really any more operating leases. If you're using somebody else's lease for more than 1 year, it's going to go on your balance sheet as an intangible right to use asset and a lease liability to kind of show the present value of the payments that are subject to that 5-year term, for example, of how long the lease is going to last. On the lessor side, you're going to recognize a lease receivable, basically the opposite of that lease liability amount, and then a deferred inflow of resources, and you recognize the revenue in the year in which you earn it over the course of the term. So one of the big definitions for GASB 87 is what kind of subjects this to a lease, because there's a lot of discussions about contracts, and something might be called a lease, but it's not really a lease. So the actual language in the contract is usually irrelevant. It's literally the substance over the form of the contract. So if the nature of the transaction is that another entity has conveyed control to another entity to use their asset, that's generally a lease. So the couple of things in this paragraph that really kind of are key to point out is the conveys control part. So basically a lessor has to give a lessee an asset that is the present service capacity of that asset and the right to use it in the way they see fit. Now, you can limit that in the contract a little bit, but essentially is if one entity gives other entity asset for a term of a length of term, it also has to be a non-financial asset. So basically that means anything other than cash or investments. It's got to be like a piece of land, a building, equipment, stuff like that. And then finally, it has to be an exchange or an exchange-like transaction, which basically means is there fair value. So is it an arm's-length transaction? Is the price of what is being paid representative of the fair value of that asset? And if all those things are met, then it's probably subject to GASB 87. As we'll see in a minute, there are going to be some exclusions, but that's kind of the starting point. If you're using somebody else's asset for over 1 year and you meet these qualifications, you're probably subject to GASB 87. As I already mentioned, there is no more distinction between operating and capital leases. So if you're subject to GASB 87, it's a capital lease, it's going to go on the balance sheet, and you have some note disclosures. If you're under 1 year, which is what normally be considered an operating lease, it's just an expense. There's no special disclosure requirements. This is actually one area that's a little bit more simpler than the FASB side of leases. So for some of you that might have watched both different presentations on leases, just be aware that the GASB lease is a little bit different on the standards and actually is a little bit simpler than that's not normally the case with GASB, but this one it is, luckily. The other point here is the contract that transfers ownership. And that's one of the key parts is if at the end of the lease term, let's say it's a 5-year lease term, that the asset becomes the lessee's asset, that's no longer a lease, it's like a finance purchase. So it's just your asset. It may be called a lease, but if you retain ownership at the end of the lease as a lessee, and there's no termination clause to cancel that lease prior to that term, it's a finance purchase and you do not have to follow GASB 87. One thing to note is the bargain purchase option is kind of a really older thing. I think it goes back to when operating capital leases, there's that 4-part test. But for GASB 87, even a bargain purchase option that you are reasonably certain you're going to exercise it because it's only $1, is still not a transfer of ownership until that option has been exercised. So if you have a 5-year lease for equipment with a bargain purchase option and you're sure you're going to do it, it's still not your asset until after that 5-year ends and you have that option to purchase it. So it still qualifies as a GASB 87 lease. One thing to maybe try to do is get new contracts, language change. So it's not really a bargain purchase. It's just becomes your own asset. That could be a way to make it a little bit simpler in the future, give the ability to change those contracts. Certain regulated leases are not subject to GASB 87. We don't see many of these, but I know there's probably at least one person in the attendings today that does have some of these leases. So if you have, usually it's US DOT or the federal FAA, they may regulate leases of certain tenants, basically. And in those situations, there may be external regulations that limit various lease rates or what tenants can be in that space. So there's some different regulations there. And basically, if you're having a lease that is subject to those external laws, that does not follow GASB 87, and you have to follow the terms of the contract, which makes it a little bit simpler, but we're going to skip that one because it doesn't apply to most people. GASB 87 also does not apply to any of these items. Again, I don't think many of you on this webinar are going to see many of these. However, if you're a larger county or even a town and you gave a vendor some right to explore your land for natural resources or timber rights, even though they have a right to use the land to do a certain activity, that's not subject to GASB 87. So anything you see on this list would not be subject to GASB 87, and you would follow other standards for that. And with that, we get to the first poll question.
Okay, everyone, if you want to just take a second to complete the poll, I'll give it a minute and then I will share the results. You almost have 100% participation, so I'll give it just another minute. Okay, we'll end the poll and I will share the results, Seth.
Right. Yeah, so as we would expect, probably there's more on the lessee side, some area for us to CP credit, and a few lessors in the crowd. So moving on to lease term. So lease term is kind of probably more complicated than you might think. So we'll get into the details. The complications really come up with the options and kind of how all those rules work. So the main part is the term of the lease first includes when the lessee has a non-cancelable right to use the underlying asset. So if it's a 5-year lease, that it's a 5-year term. That's kind of what starts it. Where the tricky part comes in is when the lessee or lessor have the option to extend or terminate the lease, and that they are reasonably certain that they're going to exercise that option. So if you have a 5-year lease and the lessee has an option for 2 years to extend it, it becomes a 7-year term, and you value the lease over 7 years for terms of GASB 87. Where it gets sticky is if the lessee and the lessor each have their own option where either party can extend or terminate, then you do not include that extension or option to extend or terminate in any situation. It's only when one or the other has the option, and when one or the other has the option and you are reasonably certain that the option will be exercised. So where this gets really tricky is, let's assume you are a lessee and the lessor has the option to terminate. The lessee has to make the determination if the lessor is reasonably certain to terminate the lease. So it's not even an internal decision, it's something somebody else is doing, but that determination of what you believe they are going to do affects the term of the lease. And in the next slide, we'll go over where you can kind of look for some guidance on what you might look at, but that's going to be somewhat of a struggle if you have some of those option terms. The other item is you also don't include the periods in which lessor or lessee can terminate the lease without permission from other parties. So the common one is if you have like a month-to-month lease, If their party can terminate anytime, then you don't include that lease term. So generally, the lease term for GASB 87 is the non-cancelable period plus any additional years in which one or the other entities can reasonably certain exercise that option. And we'll go through some examples of that in a little bit. Generally, a fiscal funding clause does not affect the term. So a fiscal funding clause is when a government may have a clause in the lease that says, if the budget was not passed, then you can terminate the lease. It's kind of a way out if the budget was not approved by whatever entity, voters or boards or whoever needs to approve that budget. In that case, you just ignore that for terms of the lease. That does not really have any bearing on when you evaluate the lease term. So some factors to consider for reasonably certain. If there's a significant benefit, basically, so if the option calls for it's a significantly good rate, that might be a reasonably certain. Say, yeah, of course we're going to extend this. It's a good rate for us. Or we're not going to terminate because it's going to cost us 3 times the cost. So why would you ever want to terminate the lease? So if it's reasonably obvious and you can say that makes sense, that's probably the easiest one to follow. If you don't have that situation, maybe looking at the history of exercising the options. If it's a long-term lease relationship where you've done the same lease for 20 years with a certain entity, there's a history of exercising those options that can be looked at. And then finally, of course, if you're a larger government, maybe and you're leasing out a large building that contains public coming in and out, and it's a big detriment to your operations, where that would be a change that could be something you look at for reasonably certain. So all things that are there. It's something that probably hasn't been really dug into too much since it's not effective yet. As we start getting to more leases, we'll see what other struggles come up with this, but this could be a sticking point where it gets a little bit confusing on what's reasonably certain. Like I said, especially when it's an option that is with the other entity, not with your entity, it's going to be kind of tricky to figure out some of those things possibly. The last thing to think about with this is the reassessment does not occur just because you change your mind. So you only reassess in certain circumstances. So if you initially assess that you're going to exercise the option, and then in the following year, like, well, maybe we're not going to, you don't change that initial term. You don't change the lease value based on that unless there was a factual change. So if you assume you're going to exercise the option and the next year you did not exercise it, then that could be a change for reassessment, but you just don't kind of go back and forth. And Sarah's going to go through some other slides later on that will kind of talk about more about lease modifications, and that might be a little more clear as well. Jumping into the lessee accounting. So now assuming you have a lease that's subject to GASB 87, you figured out the lease term. So let's say it's a 5-year lease. Now you got to figure out the amount. I think the amount you're going to try to determine is probably the easier part. Try to figure out the lease term might be the tricky one. So let's say you're trying to figure it out and you have a lease liability. Your initial part of this is, what are the fixed payments? You have a 5-year lease, you add them all up, that's fairly straightforward. But you also have to add any variable payments. So if the lease calls for a percentage increase every year, whether that's an index rate, a flat rate based on a CPI, something like that, you would actually add that variable payment into the lease liability because that's reasonably easy to estimate. If the variable payment is based on something that you can't easily estimate, for example, I've seen leases that have variable payments based on future sales. In that case, you do not include those an estimate for that. It's completely ignored. Those become revenue or expenses in the year you incur them. So the variable payments are only if it's reasonably certain. You include the exercise price of the purchase option as a lessee if you are reasonably certain you're going to exercise that option. Keep that one in mind. That's a little bit different on the lessor side that Sarah will talk about. So basically what you're looking at is, what are the fixed payments? What are the variable payments, exercise prices, any other payments that you can reasonably be certain you're going to be paying? And then you net that with all the incentives, and that becomes really your lump sum number you're going to pay, and then you present value that back, whether it's 3 years, 5 years, 10 years, whatever the course the lease term is. And then that present value of that lease liability is recorded on your balance sheet as a lease liability and then an asset. The other things to keep apart here is the present value is based on the interest rate that is documented in the lease contract. If your lease contract does not have an interest rate and it's just a series of payments, you have to estimate what is the entity's estimated borrowing rate. So you can look at other debt you've issued, other bonds possibly, and see for that term and that interest, that amount of money, what makes sense for the rate. And you use that to determine the present value. Once you have the lease liability, the lease asset, which is the intangible right to use asset, is basically that same amount. You're going to start with that present value amount, and you're going to add in anything that you may have paid prior to the lease contract. If you made payments to the entity, is like a down payment maybe or something like that. Also, any direct costs that are basically paid to put the asset into service could be added to the asset. But I think for most cases, you're probably going to see the lease asset equal lease liability. And then you're going to amortize that lease asset over the shorter of the useful life or the lease term. Except if you have a purchase option and you are reasonably certain you're going to exercise that option, then you're going to use the useful life. And the purpose of that is you want to match up the lease asset and the lease liability. So you're going to use the lesser of those to make sure it matches up best you can. If you intend to purchase the asset, then you want to amortize it over the life of the asset, and that also makes sense for that. The only time you wouldn't amortize the asset is if it's a non-depreciable asset like land, and you would not depreciate like you normally would do any other land asset. The only other part here is if you are a county government or municipal government, if you have a governmental fund, it does not affect the balance sheet. But in the year you have the lease, you're going to record that lease effectively the same as you would any other debt issuance. So you'd have a lease expense for the full amount, and other financing source is basically a revenue for the full amount. And then in subsequent years, you have a lease payment and principal and interest as a debt service. So you can treat it just like any other debt financing. For the footnotes, I'm not going to read through every one of these, but there's a whole list of footnotes that are required by GASB 87. They're fairly straightforward. The kind of the big ones is you're going to have to disclose the intangible right to use asset as an asset class. So very similar to your capital asset disclosure, you'll have an additional line in there basically for accumulating all of your right to use assets as the intangible right to use assets. In the asset terms of amortization and useful lives and all that. And then similar to debt disclosures, it's going to be the principal and interest to maturity. Again, very similar to the debt disclosures, and then all the other items there are fairly straightforward. The lease liability would be remeasured in a subsequent year if you have certain changes. So like I said, you normally don't want to just change lease liability of the term based on a change in estimate type item. But if you had a real change in the lease term, or if you change the reasonably certain because of a certain purchase option, something like that, maybe an amount change or interest rate change. I don't know how often that would actually happen, that the lessor would change interest rate on you. That would be a breach of contract. But if any of those things were to happen, only in those situations would you change the lease liability amount. And then generally any change in lease liability will also then affect your lease asset, since that was really based on that valuation as well. And with that, we can go to poll question number 2. So assuming you have a GASB 87 applicable lease, the lessee should recognize a debit and a credit of one of those 4.
Remember, everyone, this is a 2-part question. The second refers to whether or not you are attending to receive CPE credit. We do use this to determine whether or not we'll send you a CPE certificate for the session. So please accurately complete that, and of course answer the poll on the LESSEE. We'll give it another minute since there's 2 questions. You guys are fast. This is moving really fast. All right, I'm going to end the poll.
Yes, that would be the correct answer there. The lease right to use the lease asset and the lease liability. Question B.
That we will move into lessor accounting. So as that quiz just asked, and as Seth had mentioned, on the lessee side, they recognize that right to use lease asset and lease liability. On the lessor side, so I'm the one with that capital asset that I'm leasing to another entity, the lessor recognizes a lease receivable and a deferred inflow of resources. And then keep in mind that the lessor also owns that asset, so they would already also include the asset in their capital assets. So a lot of the accounting is similar, so I'll focus more on pointing out some of the differences, but the initial measurement of the lease receivable really takes into consideration most of the same things that Seth already discussed. So the fixed payments, the variable payments, if they're only really variable based on some sort of index, so you would record them at that initial rate. Residual value guarantee payments, I think that would be pretty unusual in practice to see those. So that would be if the lessee agrees to guarantee, so in the lease itself, the lessee guarantees that the asset will have a value of X at the end of the lease term. And so this is an initial measurement. At initial measurement of the lease, the lessee knows that that value will be X minus something, and they would then have to pay the lessor that difference. If somehow they magically know what that difference is at the time of the lease inception, then that would be recognized as part of the lease receivable. And then again, it's reduced by any lease incentives, which I'll talk about a little bit more later on, and net of any provision for an uncollectible amounts, if there are any at that lease inception. The variable payments that aren't just based on a rate, Seth mentioned those as well. They're also not included in calculation of the lease receivable. So let's say that I'm a school district and I lease buses and a portion of my payment is fixed, or sorry, let's say I'm an entity leasing new buses and a portion of the payment is fixed and the portion is based on miles driven. The lease receivable would just be calculated based on that fixed piece. You would never include the mileage piece in that. Similarly, let's say I operate an airport and I have not one of those regulated leases, but I have a retail facility leasing space within the airport, and they have a fixed component to their monthly rent, and they also have a portion based on sales. You would only include that fixed piece as part of your value of your leased receivable. Finally, the only major difference between the calculation of the lessor's lease receivable and the lessee's lease liability is that on the lessee side, as Seth mentioned, if that purchase option is expected to be exercised, that is valued as part of the lease liability. On the lessor side, and really because it would be more of a gain you would expect on sale, you do not recognize that option until it's actually exercised. So that is not valued as part of your lease receivable. So that's the lease receivable side. Your offset to that on the accounting is a deferred inflow of resources. That most of that amount is just your lease receivable, but then you would add to it if there's any prepayments by the lessee prior to the inception of the lease, you would include those in deferred inflows too, and then you would recognize that in a systematic manner into rental income revenue. As I mentioned previously, just a reminder that you do still recognize that capital asset. And you would depreciate it normally. The only exception would be if the lease stipulates that the lessee must return it in its original condition, then you would cease depreciation during the lease term and continue it again once that lease expires. Next slide. So the big difference here on the lessor accounting is that you do record it in both the governmental funds and the government-wide statements if you are an entity other than a business type activity who just uses the accrual basis of accounting. So if you use the modified accrual basis, your fund accounting, you need to record that lease receivable and deferred inflow of resources on a fund basis as well. So the biggest place that we expect to see this with significant activity is in BOCES. So BOCES typically leases, computers, copiers, other equipment to school districts. So the district, as the lessee, would be recognizing, again, that right to use lease asset and the lease liability only on a government-wide basis on the balance sheet. But the BOCES on their fund basis balance sheet would be recognizing that lease receivable and the deferred inflow of resources. And then in subsequent years, basically, as the payments are made, you would debit cash and then you would credit your lease receivable and interest income for the portion applicable to interest. At the same time, you would recognize, kind of your monthly share of deferred inflows into rental income. Typically at the same time, I would think that those payments are being made, so most likely monthly. The footnotes to the financial statements are similar as they are for lessee accounting. So the general description of the arrangement, the total amount of revenue recognized. So keep in mind for those variable payments, even though they are not calculated as part of that lease receivable, you do still disclose those in the notes. And you do also have to separately disclose those residual value guarantees if you happen to have them. Any options by the lessee to terminate need to be disclosed if the lessor has issued debt secured by those assets. And then other disclosures for unique situations. Seth had mentioned that leases of investment assets and regulated leases are not accounted for under GASB 87, and that is accurate. However, you do have to disclose them still. So that portion of GASB 87, those provisions are applicable to them. And then subleases, sale leasebacks and leasebacks would also be disclosed. A quick example would be if you lease a building from someone and then lease back to them, a floor for their use, you would need to disclose that as well. On the difference is on the lessee side, the lessee needs to disclose their payments in for the next 5 years for principal and interest, and then in 5-year increments thereafter. On the lessor side, you do not need to disclose that unless your primary operations are leasing. Otherwise, you do not need that schedule from an inflow side of what you would be receiving. Seth mentioned remeasurement is really the same for both, that you wouldn't expect remeasurement typically unless there is that change in the lease term, in the interest rate charged, or expectations on those variable payments. So if you were that entity with the buses and the portion that was mileage, if those became fixed payments, you would need to remeasure that lease, and we'll go into the accounting for that in a few slides as well. I think we have a poll question next. So on the lessor side, so same answers, but now we're asking for the lessor versus the lessee.
These questions aren't as fun as Kim's presentation.
Yeah, I know. We could have made fun ones instead of technical ones.
Give it a few more seconds, folks. All right, we're at 90% participation, so I'm going to end the poll and we'll share the results.
Okay, good job. So the majority of you did get that right. A lease receivable and a deferred inflow. That second one is how lessees record it. And then the third and fourth are just pieces of what each of them do. So yes, lease receivable and deferred inflow. So we mentioned lease incentives that are included as part of that calculation. This relates to both lessees and lessors. So on the lessee side, it's part of the calculation of the lease liability, and on the lessor side, it's part of the calculation of the lease receivable. It's comprised of the payments made to or on behalf of the lessee or other concessions granted to the lessee. It includes rent holidays, which would be something like, let's keep with the busing example. Let's say that the school district leasing those buses isn't required to make payments over the summer, that they just make payments during the school year. Reductions of principal or interest, and then assumption of a lessee's pre-existing lease obligations to a third party. Where I think we've all personally seen that is if we've ever, in the private sector, if we've ever leased a car, is where your new lease company pays off your prior lease if you have any remaining payments as part of that. So all of those things are deemed to be lease incentives. So if it happens, if the lease incentive is paid prior to commencement of the lease term, it is just not, it's deducted from that originally calculated right to use lease asset for the lessee or the deferred inflow of resources for the lessor. So it just nets against it immediately. If it's paid after commencement, it should be shown as a reduction of the lease payments in that period where the incentive is provided. And then as a reminder, the fixed payments are included in the initial measurement and remeasurement, and variable payments are not. And there's some unique contract situations. So this is more of a broad overview. You know, many of you won't have these situations, but I am sure that some of you definitely will. So we just want to make you aware of them so that when you are determining your leases, you know that you need to pay attention to these components of your leases. So you could have contracts containing both a lease component and a non-lease component. So for example, you could lease a building, but part of your payments are for the lessee's share of utilities and maintenance costs. If that is the case, then you should use the best estimate to separate out the lease of the building from those maintenance costs. And then you would only account for the piece related to the building as a lease. The other amounts would be expensed as incurred. If you are unable to determine, then the entire contract would be accounted for as a lease. You could have an issue where you have multiple assets with various lease terms or of different asset classes. So where practicable, those should be accounted for separately. This could be a contract where you are leasing both a building and say a parking garage. The building would be a 30-year lease. Let's say the parking garage was a 15-year lease. You would account for those as two separate leases. Again, unless it's not practicable, and then you would account for them together using the largest piece as your basis for how you calculate it. Contract combinations. So if you enter into contracts near the same time with the same counterparty, they should be considered one if they were negotiated together with a single objective, or the price is dependent on the entire package. So let's say you're leasing vehicles and then you decide to add another vehicle onto that. Shortly thereafter, you can account for that all as one lease. Next slide. So those lease amendments that we discussed, are either accounted for as lease modifications or lease terminations, depending on the circumstances. So this slide is talking about the lease modifications. And basically, it should be considered a modification if the lessee's right to the use of the asset decreases. So, I'm sorry, did I say unless the right decreases, or did I say that backwards?
It's an unless.
Okay, good. So, so you show it as a new lease if the modification adds use of the asset or assets. I think that's Seth's dog maybe in the background too, agreeing.
Mail's here.
And the resulting increase in the lease does not appear unreasonable. So what that means is, and this is right from the implementation guide too. Let's say you're leasing, I don't know, 2 computers for $200,000, and you add like 200 more computers to it, and your lease becomes like $205,000. That's not really a reasonable increase in the lease payments, because that doesn't seem like that correlates to the increase in the computers you added to that lease. So if it is not unreasonable, if the increase in the cost of the lease seems to correlate with the increase in the number, in this case, of computers, then you add it as a separate lease. So you have your existing lease, and now you have a new lease for the new piece of it. If that is not the case, then you need to remeasure, depending on whether you're the lessee or the lessor, the lease liability or the lease receivable. And if you're the lessee, then the asset would be adjusted by the difference in the lease liability, with any excess reported as a gain. If you're the lessor, the deferred inflows would be adjusted by the difference in the lease receivable, with any change in the current period recognized as a revenue or expense. So basically your asset or your liability can't be reduced below 0. So if it gets to 0, then the difference hits the gain or loss. Lease terminations on the next slide are accounted for those that decrease the lessee's right to use that underlying asset. And they are considered either a partial termination or a full termination. And in essence, you just reduce the carrying value of the lease asset and lease liability. So it's the right to use lease asset and lease liability for lessors and for lessees, and then for lessors, it's the carrying value of the lease receivable and the deferred inflows of resources that are reduced. And so it's not a significant difference from the lease modifications when the modification is unreasonable. So if the modification to the lease, again, seems reasonable, the increase in the usage kind of matches the increase in the assets that are being used, you add a new lease. Otherwise, you really reduce the carrying value of those assets and liabilities. Subleases. So a sublease includes the original lessor, the original lessee, and then the new lessee. The original lessee also becomes the lessor under the sublease to that new lessee. So I lease an asset from the lessor, and then I, am allowed to, under the terms of the lease, sublease that to someone else. Perhaps I don't need to use it now. And so I now have 2 leases. I have the lease where I am the lessee, and I am the lessor to this now third party who is leasing it from me. You do account for those as 2 separate transactions. You can't net any of that. And you should separately disclose the information on your role as the lessee and then your role as the lessor. Okay, so for implementation, if you've as Seth mentioned, he and I have presented this a bunch of times, but we do strongly recommend that you also familiarize yourself with GASB 87 if you haven't, and we've provided just a very short link to it there. Also, there's an implementation guide for GASB 87, and if you're not familiar with the implementation guides, this one is specific solely to GASB 87, and it really just includes questions people have submitted in the implementation process of how they would account for things in certain situations. We pulled, I think, 12 of those questions, so we're going to go through those next, but in a very quick 4 minutes, I think, Seth. And but there's about 75 questions in that implementation guide, so that link is there as well. We did, as Seth mentioned, work on development of an analysis tool in Excel for these purposes, which the link is there and is available on our website. We do suggest considering materiality. Every governmental accounting standard and financial accounting standard says it need not be applied to immaterial items. So if you have one lease and you don't think it's significant, either from materiality from your, looking at your total assets and your total liabilities, as well as your capital asset capitalization policy, I highly suggest discussing with us, if we're your auditors, on whether or not you think that needs to actually be accounted for under GASB 87. Finally, if you do have debt covenants that you have to meet for your debt, keep in mind that you would potentially have new lease liabilities you're recording, and ensure that those don't impact those agreements. And if they do, make sure to talk to the banks ahead of time to see what you need to do about that and if that can be changed. So with that, I'll give it back to Seth and we'll go through some of these questions.
So we won't have you guys enter anything into chat because this, in the interest of time, I'll try to go through the question and kind of the main points of these. So as Sarah said, these come from the implementation guide. And really what it was is it's, the draft GASB comes out and people submit questions on what do you do in this situation? How's it going to work? So these are GASB answers that we've copied in here. The first one is if a government basically leases land that's worth $100,000 per year, but they only have to pay $1 per year. Is that subject to GASB 87? And this is the answer from GASB itself. But the answer there is no, it's not an exchange transaction because you're paying $1 for $100,000. So then it's not subject to GASB 87 is the point with that one. Question number 2, if you're a government that enters into a multi-year agreement for the right to use a facility, and then in this case, the contract limits the use of that facility to 3 days a week, is that subject to GASB 87? And the answer is, well, the answer is yeah. I said that wrong. It is subject to GASB 87. It is not. It does not need uninterrupted control for that. So if your lease contract specifies a shorter duration of time, then it's subject to GASB 87. Just because they only had it for certain days doesn't really exempt them from recording under the lease standard. Question 3 gets into if you have a leased asset, think of like a computer or maybe a vehicle, and the lessor wants to substitute that for a different identical asset. As long as it is identical and you get the same service capacity out of it, then that does not change the right of conveying control, so it still would be a GASB 87 lease. Question 4, this is a non-cancel period of 5 years, and both the lessor and lessee have the right to cancel. This is one, like I said, by the second slide, where if both parties have the right to cancel, then that optional extension year termination periods are not subject to GASB 87. So it would only be the initial 5-year period. This is the exact same question, but it's basically the termination part of it. So even though there's penalties, all this stuff's all kind of excessive questions into this, but should the cancel periods be excluded? Yes, because both parties have the option. So whenever both parties have the option, you basically ignore those periods for the lease term questions. And then question 6 is the exact same question, except only the lessee has the option, in which case then you would consider that if it's reasonably possible, essentially is the next question of that. But if you are reasonably certain, then you would include that.
Okay, so Seth, let's skip to number 9 in the interest of time. Again, these are in our presentation with answers and in the implementation guide. So I'll just try to focus on ones I think pertain the most. A lease contract for copy machines requires that a minimum amount be paid for toner and paper, regardless of whether these supplies are obtained. Should some portion of the minimum amount to be paid for supplies be included in the measurement of the lease liability? And the answer is, unfortunately, it depends. So, and there's a lot of double negatives here. This is GASB's response. If the amount allocated to pay for supplies does not appear to be unreasonable, so let's say it seems reasonable, then you should account for the supplies separately from the lease. So like I mentioned before, you would only account for the portion allocated to the lease under GASB 87. If it does seem unreasonable, like it's a huge amount for supplies and it just doesn't seem to make sense, then perhaps it's really a fixed lease payment and should be included, but there's professional judgment required there. Question 10, we talked about this. A school district leases buses for 2 years and is required to make variable payments on the number of miles driven. There's no minimum payment requirement. They're reasonably certain of the minimum number of miles. So should they, in essence, should they use that estimate of their reasonable miles in determining that lease value for their lease liability? The answer here is no. Keep in mind, it's just the fixed payment that is included. So if there was a minimum fixed plus the mileage, it would just be that minimum piece. There's no minimum, so there's zero. You would, however, still have to disclose it, unfortunately. And then let's skip to number 12, because that's actually our 4th poll question as well. So while a lease contract is in effect, the provisions of the contract are amended to change the number of vehicles included in the contract. Are additions and subtractions of underlying assets in a lease accounted for as a lease modification or a lease termination? So a modification, a termination, or it depends.
We'll just wrap this up in about another 30 seconds. Okay, we're at 92% participation, so I am gonna, actually 94 now, so I'm gonna end the poll and share the results.
Great job, everyone. You are almost all correct. It does depend. This question doesn't tell you whether the lessee gets more or less use of the asset. So if it's more use, then it's a lease modification. If it's less use, it's a lease termination. So good job. And then the final thing we're going to just spend a minute or two on is the tool, the Excel tool, and Seth will go through that.
Yes, just a few seconds on this. It's on the link. So it has 2 tabs, one's for the lessee and lessor. And basically you can use this to kind of get your thoughts together. It's useful as a checklist. We'd only recommend using this if you have a relatively few number of leases. Anytime you use Excel for counting and documentation purposes, if you had hundreds of leases, a software system would be probably better, just because it gets very tedious and mistakes can happen. Anything in these gold shaded cells are formulas that are linked to various other answers. So these things I populated are based on the question numbers we just went through, 1 through 12. So some of them don't really apply to this, but basically it walks you through the steps of the questions. Is a legally binding contract, a lease? Do you have present service capacity? So you kind of take a step through and it evaluates kind of where. So question number 1 we had kind of fell apart on this part. So if you kind of follow this through left to right, it will go through all the things that Sarah and I went through, tell you what's excluded, transfers of ownership, and the very far to the right we have interest rates and payments. If you put some amounts in here, it will generate the fair value or the present value, so you can record those based on this. So again, it's only as good as you put into it. And from talking to people and clients, the real struggle is really researching what leases you have and getting all these details correct. They're really case by case basis, and the struggles when you have a lot of leases and they're all different and they're unique. And then that really comes to the time effort is really putting into evaluating what's subject to what terms, what extension periods are applicable or not. The underlying math of it, the calculations are actually fairly simple once you have the basic information. So this is supposed to help just kind of organize your thoughts onto those items.
And keep in mind too, that this is leases under GASB, not leases under FASB. So if you're attending this session for the CPE credit, but you actually are with a for-profit entity, or you're with a nonprofit, it's also under FASB, then do not use this spreadsheet, because it will, although they're similar, they are not the same. So it won't necessarily give you the answer that you need. I think that wraps it up. Don't see any questions. Obviously, please reach out to Seth or me or anyone on our government services team if you have any further questions on this. I know, you know, a lot of you we've been speaking to about this already. But thank you for listening today. Thank you for attending, and I'll pass it to Maria for our final information.
Yeah, we're just about 3 minutes, so it's great. Thanks for staying on time, Sarah and Seth. So that concludes day one. Thanks again for everyone for participating. I did put in the chat Sarah and Seth's email address. Of course, you can find that on our website, and I've seen a couple of you go to the bios, which is great. So hopefully you're reaching out. And I see a couple of thank yous in the chat, so thanks right back. And I did link the sessions for tomorrow. We'll also send a reminder email tomorrow morning. So we hope to see everyone tomorrow morning at 9 with the economic update. Then we have federal stimulus funds and leases, accounting leases for nonprofits. So again, thanks for attending today. We'll see everyone tomorrow. Have a good day, everyone.
Bye.
Thank you.